After seeing an unbelievable bull run through 2021, it appears to be the opinion of most investors that 2022 may be the start of the crash. But let's have a speak about why this crash could be very different to ones that we have seen in the past. Now, I do encourage you guys to like and subscribe if you enjoy this sort of content, because we do make videos like this almost every single day talking about all different sorts of economic factors. So we're going to jump in now, and we're going to start off by looking at the video's objectives, what we want to cover. In this video, we're going to be looking at the main market factors leading many market analysts to believe that a crash could be ahead. We're going to be talking about this in extensive detail with a lot of research, and we're also going to be looking at the data to analyze the housing market, the stock market, and the wider economy. So I do encourage you guys to watch all the way through till the end. It did take quite a while to make this video, so if you could just watch it all the way, that would be massively appreciated. We're going to jump in and we're going to start off by looking at the current situations across the whole economy. We are seeing a unique situation. In the past 2 years, the markets have been rallying very heavily. We're reaching all-time high levels, and that's right after the pandemic. Overall though, the situation in the economy is fundamentally weak. Inflation is high, interest rates are low, there's a looming recession, there's a global food crisis, and mass layoffs are happening at multiple different big name companies. So we're seeing the effects of this play out differently in each and every sector. Let's have a look at these in a bit more detail. And we're going to start off by looking at the stock market. Now, the S&P 500, which is a chart that we have here, is a perfect indication as to what's going on both in the stock market, because a lot of the major indices, such as the Dow and the Nasdaq, are mirroring this, but also a wider view of the economy, because the S&P, for those of you who do not know, tracks the top 500 companies in the United States. Anyway, what we're seeing here is a rapid rally in the past year or two post-pandemic. Again, coming into the midpoint of 2020, we can see that big run, and it really is one of the steepest that we have seen. Now, what we can see, there's no apparent reason for it to hit these highs, not fundamentally at least. Again, we could talk about stimulus and stuff like that, but realistically, there hasn't been any rapid growth in the US economy like this to see this one expand so quickly. Again, so what should we be expecting here? At some point, this bull run is going to end, but especially right now with the economy looking very, very weak, the question is, where will this actually end up? So we're starting to see this downtrend again from about December of 21, especially for the majority of 2022, continuous downtrend throughout each and every month. And again, this has not stopped up until now. And the reason why this is so interesting is because when we look back to the history of the S&P 500, we can see one thing is very clear. Each rally has its pullback. Now, we're going to be seeing this one rally significantly throughout the 90s, coming into the 2000s, and then we all remember what happened in the 2000 period where we had the dot-com bubble around that time. Then coming into 08, 07, we had the financial crash. And coming up to 2016, which by the way is the most recent date on the chart, well, not really anything happened. Now, if you're looking at this chart, one thing which is going to stand out, yes, we had that run in the 90s, very, very significant, but we really started to calm down after that. Now, coming into 2010 all the way up to 2016, again, the most recent date on this chart, we saw this huge rally. And again, it's taken us significantly to all-time highs, something that we have not seen before. And it's a lot steeper than what we saw even on the previous rally. Now, why this is so significant to me is because, look at this, okay? This run is very steep, but this is 2016. This data is out of date. And I brought this in on purpose. I used this chart on purpose. So for those of you wondering why I used that old chart, there's a very good reason for it. And there's a reason why I also left the numbers on the side. So what we've seen here is a high, which is around, I would say, about 2100. I think that's a fair guesstimation. So 2100 points is the high of the S&P in 2016. Okay, that's a fair assumption. Now, why this is astonishing is because a couple of years later, the high of 2021, well, that was on the 23rd of December, and it was 4,725 points. Again, that's up from around 2,100 up to almost 5,000. That's almost a growth factor of 100%. Now, can we assume that the US economy has grown fundamentally by 100%? Well, I do not think that is the case. And again, this run is okay if it was happening with a steady trend, continuous pullbacks, and that sort of thing, but that is not what's happening. Again, look at this one, look at the rise that we saw. We were rallying from 2016, and again, this chart from 16 shows us the continuation into 17 over here, where we saw this rise slowly carry on, and of course it all ended at about 3,100 points in 2020, coming down to 2,500 again. Now from April of 2020 all the way up to December of 2021, again not too long of a period, we rallied from 2,500 to 4,700. That's a rise of just over 2,000 points. 2,000 points in about a year. You guys see what I'm trying to say here? For the context, what we saw in the 90s, all the way from about 1988 to about 1998, I should say. So a 10-year period there, we saw a rally of about a similar amount, you know, coming up to just over 1,000, coming into 2,000 points roughly. That's the nearest thing that we have on this chart. So you see how quickly this growth really has taken off. This has been something unlike what we have seen before. And it is startling to see growth like this happen so very fast without cause. And now let's have a look at the housing market, because I think this is also correlated. I'm going to talk about this more in a moment. But first, let's have a look at the housing market factors on their own. 3 different pieces of info here. We're going to start on the left. US house prices versus earnings. Now, we've spoken about this ad nauseum in the last couple of days, so I'm not trying to go over it too heavily, but what we're seeing overall, earnings are not keeping up with the price of houses. Last time we saw anything like this was back in 2007-2008, in the credit crunch, the financial crash. Now, the tracking for prices in houses, we're seeing that also go to new levels, i.e. house prices are reaching new highs. And simply put, at this level, with house prices at new highs and earnings not matching it, people can't afford it. We're seeing that from this data from the National Association of Realtors. Home sales were down 5.9% in July compared to June, the 6th month in a row that sales have declined. They are now down 20% from a year earlier. The same report shows us that the median price of properties is currently $403,000. Now yes, that is down from $10,000 in June, but look at the trend in the past couple months. Now look especially from February of 22. Prices have increased rapidly. And we're starting to see this slow down into July like we spoke about in the last video, but really what we're seeing here is somewhat similar to the stock market, where prices have rallied extremely for no particular reason. Now, I think there is some correlation in the sense that look at how the housing market has gone up in 2022, where the stock market has gone down in 2022. I think investors are probably hedging against the stock market using the housing market, but this cannot last forever, and prices are going to come back down to normal levels. And this is going to be significant both in the stock market and the housing market as well, for reasons which we'll speak on in a moment. But let's have a look at people's personal finances before we do look at how this all adds together. So debt. People are buying stuff with money that they just do not have. So US debt is now at 16.15 trillion. That's an increase of 312 million. That's 2% since the previous time it was recorded, and we can see balances now stand at 2 trillion higher than the end of 2019, before the COVID pandemic. This chart here shows us the picture of what we're seeing when it comes to debt in both emerging economies, the line below, and advanced economies, the line above. Now look back to 07-08. Around that period, people were borrowing heavily prior to that. But what we're seeing now is we're seeing that trend continue. And this is again data from 2016. Coming back to our earlier chart from over here, do not think the trend has not continued like I showed you with the S&P. Again, the figures, like I just said, are rising. We have the data to prove it in these numbers over here. So we can see these debt levels are much higher than even what they were here. So just imagine the chart going like this. It's really just spiked up to unbelievable levels. And there is a cost, a real cost of debt. Sure, debt allows us to finance things which we couldn't otherwise afford, but it does come with a cost. In the short term, debt may be good for boosting economic growth, because people are going to use that money to buy things that they couldn't always afford, like new homes, cars, and other things like that. So of course, what's going to happen with that is, say, automakers, as it says down here, and this is coming from the IMF blog, if you're wondering, the International Monetary Fund. But yeah, companies are going to employ more people because they want to keep up with demand. But later on, indebted households may need to cut back on spending to repay their loans. That can drag down growth, and we can see jobs being cut as we saw in '08, and a sudden economic shock because of this. So that can trigger a decline in home prices and a spiral of credit defaults that shakes the foundations of the financial system. Now, we saw that previously, as I mentioned, in '07, '08. And this is why we're looking at something so very significant here. I cannot even get across how big of a thing this is. Imagine 2007, 2008. We know how big of a crash that was. But we're seeing figures now which are significantly higher. Again, coming back to that point, we saw the S&P much lower than where it is right now. We saw the price of houses much lower than it is right now. On a apples to apples basis, we were seeing similar things when it comes to the rate of inequality when it comes to people's earnings and house prices, but prices themselves are at all-time highs. And again, we're going to be seeing more job layoffs as we're already starting to see. Debt is much higher than it was back then. And it's all going to add up, and it's going to put us in a position unlike what we have seen before. Because again, in former crashes, people have not behaved like this in the prior period. We haven't seen a pandemic like this. We haven't seen unprecedented economic support from governments, from stimulus. We haven't seen a global shutdown. And again, even in '07, '08, we didn't see inflation rates as high as what they are now and what they're predicted to go to. And here are a few of the reasons which I believe that this could be one of the worst crashes that we've seen in some time. So we have an extremely poor economic situation at the moment. We have, again, like you just mentioned, people who have more debt, people who are struggling more, people who are having less real terms money to actually spend. And that is not a good thing. Again, debt is at a high level, both on a personal household level, but also on an economic/government level because of all of the support in the pandemic, as we know. We've seen an extreme bull run for more than 10 years, and what that means is, with this extreme growth, we have a longer way to fall to the ultimate bottom, and again, more potential room for downside. We're seeing overinflated values in each sector, like you said, house prices record highs, the stock market at record highs as well, and there's not really any particular reason for this. And we've seen an increased pressure on people's finances from inflation, from low interest rates. All of these things are hurting people's personal finances and their real terms ability to spend. I think you can see now how this is all adding up to potentially, and again, I am hoping it is not, but I think you can see how this could all add up to be one of the worst crashes/crises we have seen in some time. Because whilst we have some things which are alike to the '07, '08 crash, we have similar things, but the magnitude is much bigger. We didn't see the same sorts of problems on the scale that we are seeing right now, and that is what is truly scary about it, if you ask me. So I want to hear what you have to say on this. Do you agree with my opinion, or do you have a differing opinion? Again, this is nothing more than my opinion, so don't take it too seriously, but I want to hear what you have to say on it, so do drop me an opinion down below. Again, make sure to join us in our next episode, as we are going to be covering something of a similar topic, and if you'd like to watch extensive analysis of this sort of coverage, do make sure to watch our former videos. We've made a few videos now talking about this sort of subject, and again, they are all very interesting. I think you will enjoy each and every one of them. So, with that being stated, guys, thank you so much for joining me in this one. I hope to see you all again soon.